Your bank account does not mean you are in control. Most people believe being inside the financial system gives them stability. But the system was never designed to give individuals control. It was designed to manage them. Because inside modern banking, access is not ownership. It is participation under conditions. And once you understand what those conditions actually are, the idea of being in the system begins to feel very different. This is not about a single rule or a specific policy. It is about a structural reality. A system that operates continuously, silently shaping how money moves, who can use it, and when access is allowed. A system that most people enter without fully understanding what that actually means. To be in the system is often presented as security. Your money is safe. Your transactions are protected. Your access is guaranteed, but those assurances depend entirely on infrastructure. Infrastructure controlled by institutions. Institutions that operate according to rules, obligations, and priorities that do not always align with the individual. The first shift begins with how money is held. When you place money into a bank, you are not storing it in isolation. You are integrating it into a network. A network that immediately begins to process, allocate, and monitor that money. From that moment forward, access to those funds depends on the system functioning as expected, not on simple possession. This distinction is subtle, but it changes everything. Because possession implies control, while integration implies dependency. And dependency introduces conditions. Those conditions are not always visible. They do not appear in the interface. They are not explained during normal use, but they are always present. Every transaction you make is evaluated. Not just processed, evaluated. Before money moves, the system checks whether it should move. This happens in fractions of a second. So quickly that it feels like nothing is happening, but something is always happening. Multiple systems analyze the transaction simultaneously. They compare it to patterns. They assess its risk. They verify its compliance with rules that are constantly evolving. If the transaction aligns with expectations, it proceeds. If it does not, it pauses, or it stops. The decision is not yours. It belongs to the system. This is what being in the system actually means. It means every financial action passes through layers of institutional control. Control that exists independently of the individual. Control that operates continuously, whether noticed or not. Most of the time, this control feels invisible. Because it does not interfere. Payments go through, transfers arrive. Access feels immediate. But the absence of interference does not mean the absence of control. It simply means the system approved the action. At that moment, under those conditions, and those conditions are not fixed. They change, quietly, gradually, as the system evolves. This evolution is constant. Regulations are updated. Monitoring systems become more advanced. Data analysis becomes more precise. Each improvement strengthens the system's ability to detect risk, but it also strengthens its ability to intervene. The system becomes more aware, more responsive, more capable of controlling financial activity. And as it becomes more capable, the definition of access begins to shift. Access is no longer just about having money in an account. It is about meeting the conditions required to use it. Those conditions are shaped by priorities, not individual priorities. System priorities, stability, compliance, risk management. These priorities determine how the system behaves. They determine when a transaction is considered normal, when it requires additional scrutiny, when it should be restricted. From the system's perspective, these decisions are necessary. They maintain order. They prevent abuse. They protect the broader financial network. But from the individual's perspective, they introduce uncertainty. Not visible uncertainty, but structural uncertainty. Because the rules governing access are not fully transparent. And they are not static. They evolve without requiring acknowledgement from those using the system. This creates a quiet imbalance. The individual believes they control their money. The system operates under the assumption that it must control financial activity. Both perspectives exist at the same time, but only one determines the outcome. This imbalance is rarely noticed during normal conditions, because the system functions smoothly, but it becomes visible in moments of interruption. A transaction is declined, a transfer is delayed, an account is flagged for review. These moments feel unexpected, because they break the assumption of control. But from the system's perspective, they are routine. The system is applying its rules that were already in place. Rules that were always active, even when they were not visible. If you want to understand how these hidden financial mechanisms work before they affect you, consider subscribing. Because most people only begin to recognize them after the system has already acted. The deeper reality is that being in the system is not a neutral position. It is a relationship. A relationship defined by access through infrastructure. Infrastructure that operates according to institutional logic. That logic is not designed around individual autonomy. It is designed around system integrity. And system integrity requires oversight. Oversight requires authority. Authority requires the ability to intervene. This is why the system does not need to restrict access often to maintain control. It only needs the ability to do so. Because that ability defines the boundaries of what is possible. Even when it is not used, even when everything appears normal, the structure remains constant, unchanging in its presence, changing only in how it is applied. Over time, as financial systems become more digital, this structure becomes more significant. Physical alternatives diminish. Cash becomes less central. Transactions become increasingly dependent on digital networks. And digital networks require governance. Governance introduces rules. Rules introduce conditions. Conditions redefine access. Gradually, quietly, without needing to be announced. This is how the system evolves. Not through sudden changes, but through continuous adjustment. Each adjustment is small, often unnoticed. But together, they reshape the environment. Until the system no longer operates the way people assume it does. And by the time that difference becomes visible, the change is already complete, already embedded, already shaping every transaction, every account, every interaction with money. This is what it means to be in the system, not simply to hold money, but to operate within a structure that defines how that money can be used. A structure that evaluates, decides, and enforces continuously. A structure that does not require awareness to function. Only participation, and participation is often automatic. Unquestioned, accepted as the default, until something interrupts it. Until the system makes a decision that does not align with expectation. At that moment, the structure becomes visible. Not as a new development, but as something that was always there, operating quietly beneath the surface. Have you ever experienced a moment where your access to money didn't work the way you expected, even though nothing seemed wrong on your end?